Shares of Simon Property Group surging 9% so far this year, but Mizuho thinks now is the time to step to the sidelines. The analyst downgrading SPG to a neutral rating, cutting his price target to $193 a share. It is our call of the day. He still likes it. He thinks it's the best risk-adjusted play in the REIT sector, but some doubts here in terms of the valuation. JJ, where do you stand on REITs in general?
Well, the REITs in general, I'll take a retail perspective here on this one. I think many of them are very confusing, so to speak, for retail clients. They have some debt risk, they have some interest rate risk. That all said, if I'm investing the one that I think is appealing is Ventus, VTR. Why? They're involved in retirement communities, they're involved in healthcare communities, and they have a lot of space for scientific type labs,
et cetera. They're more defensive in terms of the end user.
It's a growing community of the end user. And so I do think, compared to some that are involved with malls, et cetera,
like
it makes more sense.
Yeah, Weiss?
Yeah, I own two. I own Crown Castle, which are wireless towers where you'll see increasing usage as they rent space out on them. It's got a good yield. You can play American Tower, but I happen to own Crown Castle. The other one I own is Agree Realty, which I've talked about, which is a triple net lease, but they only play to tenants like a Walgreens, a Panera. So those are not going to be economically challenged businesses, and it's been a phenomenal performer. Family's never sold a share that owns it, which is positive. I think it keeps going up, and it's Crown Castle. Those are two I would play.
So also a defensive sort of take on that.
So, the
so really look at what kind of customer they've got.
Right,
before you buy that. Yeah.
So even the high-end mall, the A malls,
which you would think would be more defensive in the retail sector.
Right, and you would, but I'll tell you, so I live near Short Hills Mall. They've got empty stores all the time.
They got a Houston's there, though.
Yeah.
Or Hillstone, they call it now.
Is that what they call it?
That's my
spot.
That's
the kind of place Josh goes and, traffic generator, right?
No Burger King.
You know what else? You know what else?
I'm gonna let you finish, but Hillstone is the best baby back ribs of any chain restaurant in America.
Really? I like the Thai chicken salad there.
But I haven't seen Hillstone there.
Dog. Well, they might still call it Houston's.
Did he just call you
no,
dog?
Not there.
Is this what this show devolves to? Dog? Dogs. I mean, it's awful.
Well, it's DAW.
You don't do this show that often, but yeah, that's how we roll.
Where are you in REITs? You're in REITs.
I am in REITs.
You're in store.
I have two REITs that I like a lot. The first is Invitation Homes, which is rental homes in the hottest markets in the country. Phenomenal story. But I want to talk about Store Capital. This is a stock that's been absolutely ripping, making new highs, almost regardless of what's going on with interest rates or the market, because it is a secular growth story, unreliant on the economy. It might actually even do better as the economy slows, because what they do is provide capital to business owners who own their own real estate for no reason. They get liquidity to that business owner, so the business owner could focus on growing their business. Store takes it over, does a triple net lease. They are not renting to malls. They are not doing retail that competes with Amazon. They're working with hairdressers, beauty salons, veterinarians, experiential retail like hunting and fishing stores, and it is just a gangbusters business. There are millions of small business owners in America, many of whom own their own real estate for no reason, and Store Capital is partnering with the best operators, getting store-level economics every quarter from those business owners so they know that they're taking the right risks. Yeah. They also actively manage the portfolio. So this is a name that I believe in for the very long term. I think they can grow adjusted funds from operations north of 10% as far as the eye can see.
The yield.
The yield is 4%. Good. 4%'s good. There are a lot of REITs you can get 6, but those are often in more mature situations. This is a growth business. I don't need them to raise that yield any more than they already are each year. So I think it's a great total return situation.
If that yield goes to 6 or 8, you just don't want to.
You got to worry.